All right, we're live here now for another episode of Sydecar Sessions. Super excited about this one. It's a topic that I get asked about a lot, and uh, certainly one that I don't have as much expertise as I would like. So we're really grateful to have the panelists that we do here joining us today. So I'm going to give a brief intro of them, and then we'll get into it. We're talking taxes. So it's the time of year where people are super aware of them and asking a lot of questions, trying to figure out strategy. We're going to talk about fund taxation specifically. And to do so, we have with us Ankur Nagpal, the founder of Carry and investor at Vibe Capital, who has a wealth of knowledge in fund taxation, as well as Kayla Konovitch, a CPA and partner of financial services at the tax firm EisnerAmper. And then one of our very own, Nik Talreja, the co-founder and CEO of Sydecar. So the three of them are going to lead us on this overview of several VC tax topics. We're going to talk about carried interest, management fees, gains, all that good stuff, including the Schedule K1, which is near and dear to Sydecar's heart for sure. We're going to cover a range of these topics from the fund manager perspective, the tax professional side, and really get into what you need to know from SPVs and funds when it comes to taxes. So I will get into it now. I want to give the panelists a chance to provide a brief intro and talk about your role specifically in the ecosystem. Ankur, you want to kick us off?
Yeah, absolutely. Super excited to be here. Thank you for the generous introduction. I should caveat that we're here with actual professionals. We have a CPA, a lawyer, and I'm just some dude that's been trying to self-teach myself stuff. But yeah, I mean, running a company now to help people demystify the tax code, and yeah, really excited about this.
Thanks, Kayla.
Sure. So I'm Kayla Konovitch. I'm a tax partner at EisnerAmper, as Rob had introduced. My specialty is working with private equity funds, venture capital funds, and family offices. I head up our firm's national venture capital practice. Spend quite a bit of time with emerging fund managers. So I'm really, hoping our audience will tap into it and, hopefully provide some insight to help emerging managers.
Thanks, Kayla. And Nik?
Hey everyone, Nik Talreja, CEO and co-founder at Sydecar. My background's in law, as Ankur mentioned. There is a lawyer on this call. I practiced law for about a decade. Started a fund. I was burned by an existing fund admin at the time around late K1s and just inefficient processes, and decided a software could solve for a lot of what fund managers need when it comes to building their funds, launching SPVs, just running their business. And Sydecar was born out of a personal need and became a business in its own right. So pumped to be on that journey and pumped to be here on this journey into the world of tax with you all.
Cool. Yeah, thanks, guys. Let's get into it now. I want to say to the audience, anyone listening here live, feel free to ask questions. So you can put them into the chat in whatever platform that you're watching this on, and we'll try to get to them at the end. And if we don't, then we'll get to them after. We'll follow up, and I'm happy to provide the connections with the panelists or facilitate answers to any questions you might have on the topics we're going to get into. So let's do it. I think just to kick things off, want to really try to be relevant here to VC clients. I think some of the audience here looking at the primary tax challenges, and given all of you the experience and the exposure that you have to it, could you just tell us some of those challenges that you see many of your VC clients face? Kayla, do you want to kick this one off for us?
Yeah, sure. So one of the, I think, fundamental items that VCs face, especially when they're launching their first fund, is really focused on the structuring of the fund, like getting that set up and having an understanding of what's the best and most efficient manner to structure the fund entity and what the tax impact will be. So, Nik, I'm going to turn it over to you because I think there were,
Sure.
you had some specific questions you wanted to address that you've been hearing.
Yeah, of course. Thanks for that, Kayla. When I practiced and represented funds, but also now at Sydecar, we commonly hear from many fund managers who have questions that relate to tax considerations. And oftentimes those questions are inherently tied to the nature of a fund, the legal entity and the structure of a fund, and how it either caters to things like pass-through taxation or might not, how it caters to investors in the U.S. with certain, expectations of being taxed in the U.S. and investors outside the U.S. when it comes to assets in the U.S. and assets outside the U.S. And because we're talking about U.S. tax laws, kind of why we're thinking about this frame of U.S. or OUS, but I think it all ties to kind of structuring at its core. So, just to kind of kick off the conversation, one of the questions I hear most frequently is, how do we ensure that we aren't double taxed on things like gains? And how are my investors impacted by tax considerations inherent in my fund? And maybe to start, this may be obvious to some, but almost every fund out there is formed as a partnership for tax purposes. You think of a fund as an entity that receives capital, moves money into an underlying asset. You don't want that fund to be a tax layer where you're burdened by double tax, one, on an outcome of the underlying investment, second, at this fund level. And that's why most funds are formed as limited partnerships or LLCs, both of which are taxed as partnerships. And Kayla, you could probably speak to this better, but the nature of a partnership and electing a tax as a partnership is that the fund basically passes through the tax nature of the underlying asset up to its LPs. Kayla, do you want to add anything to that?
Yeah, no, that's exactly what it is. Essentially, all the income, the credits, all the operations, it flows right up to the investor. So there's only one level of tax.
Yeah. Awesome. Another question that I commonly received is, how are foreign investors impacted by U.S. partnerships? Given that most funds are LPs or LLCs, if you're an investor outside the U.S., let's say you're in Singapore or the U.K. and you're investing in like a Delaware entity, what does that do for you? One thing that I think about, and this maybe is more of like a legal nature issue, is this concept of round tripping. But let's say you're based in Singapore and you're investing in a Singapore company through a Delaware entity. There is this concept of round tripping that sometimes comes into play. And there is a tax component here, which, you can think of this as like, let's say you're trying to avoid Singapore tax law and you're investing in the US. You might think you can kind of skip a step. But I do think that Singapore tax authorities and the IRS are both kind of smart around this. I don't know, Kayla, if you want to comment on that, but I know that is sometimes a circumvention of both tax and securities law. So anything to comment on that?
Yeah, we actually see sometimes, they'll go form their fund in a non-US country, and that entity may actually be treated, let's say, as a corporation in the foreign jurisdiction. But for US tax purposes, it may be treated as a corporation. Maybe you have to make a check the box election to treat it as a pass-through. You just want to make sure you understand local jurisdictional law and the US so that there is no duplicative double taxation. And that's why many times people are forming funds. I'm sure you commonly hear this. They're in the Cayman Islands or British Virgin Islands. So they're in these countries that are, they don't have tax treaties, but there is no taxation in that country. So that's something that will help mitigate this issue of any sort of double taxation and foreign jurisdictional law.
Quick related question, because I've had this come up a few times. Obviously, in order to be a venture fund investor in the US, you have accredited investor laws. How does that change when you have foreign LPs? Is that based on the jurisdiction of the LP, or is it still subject to US accredited investor laws?
It's a good question, Ankur. I think this one's more legal in nature, so I'll take this. If the company's based in the US, the underlying company that is raising the capital through your fund, your SPV, that company is likely relying on a private exemption to raise its capital from its investors, which will, the condition being, one of the conditions commonly being, accredited investors have to participate in the round. You can't have non-accredited investors participate. Because of that requirement, that accreditation requirement passes up to all of the investors through the fund investing in that business as well. So because the fund investing has to be accredited, you have to now look at the fund. And the most common way for funds to be accredited is for all of their members to be accredited. So as a result, it doesn't really matter if you're in the US or outside the US. That
so
fund
if
itself
you are a person who lives in, let's call it India, for instance, the threshold for being accredited is still what the US numbers are.
That's correct.
Got it. Cool.
which
Yeah,
I know
super
can
helpful.
be an extreme
Yeah,
for
of
certain
course.
other
Yeah,
places.
certain countries. Yep, makes sense.
Awesome. One other tax-related. Go ahead, Rob.
No, go ahead, Nick.
Cool. I was going to go through a couple more common questions. One, the implications of having a fund invest in another pass-through entity, given that funds are commonly taxed as partnerships. What are the things to think about when investing in another pass-through entity? I know that one of those might be the notion of how K1s can be produced for your fund investors, given that if your fund is investing in a pass-through entity, it has to first receive a K1 from the underlying investment to then actually consume tax information to produce for your investors, which is a very common reason for late K1s. But anything else, Kayla, on that point?
Yeah, we see this quite a bit, really depending on what the fund strategy is. Many times funds are just investing in corporate stock or convertible debt or something like that. That keeps the tax filing simple. But if you're investing in an underlying operating entity or in another fund, or if it's secondary strategy or something like that, you will then have to wait to receive that K1 to do your fund's reporting required filing. So often the fund will have to extend their tax return and wait to receive the underlying K1 and then do their own fund return with the K1s and issue it to investors. So there's a little bit of a delay in the timeline. Sometimes what we do is offer to generate an estimate or draft K1 in March so that investors could at least estimate and pay their taxes in time for April with their best estimate. But otherwise, sometimes the work is you do it in the summer and you don't get it out until a later date. So that's just something to keep in mind, depending on your investment type. It will impact your compliance.
Awesome. I have one last question around structuring that I commonly receive, and Rob, I'll pass it back to you, which is, Kayla, this one's for you. Anything that folks should think about when they're using their funds or SPVs to invest in entities outside the US? Any considerations?
Yes. So I always tell my clients it's perfectly fine to go abroad and make investments offshore. However, you need to understand there's additional compliance from a US tax perspective. So there's really two things that come up. One is if you're making an investment in a controlled foreign corporation, we refer to this as a CFC. If you're making an investment in a foreign corporation that is owned by US people, by more than 50% by US persons, that's what they call it, then you might be in the CFC status. And there's a lot of nuances here of what's called a person. If you have only a 8% interest, you're not even considered as part of this. You only count investors that own at least 10% when you're trying to meet this 50% threshold. So there's a lot of nuances here, but generally, if the corporation is owned, foreign corp is owned by more than 50% US people, you're now a CFC. There's a lot of additional compliance and forms that need to be filed and disclosed. In addition, there might also be some income pickup, or if people heard the term guilty, it's a nuanced area, but there's just additional compliance that you should be aware of. The second item is if you're making an investment in what we call a PFIC, a passive foreign investment company, then there's also additional compliance and potential elections and taxable income coming through, even though it's a corporation. A PFIC, a passive foreign investment company, is generally, you can meet it. There are two tests. One is either if 75% of your income is generated by passive income, like interest, dividends, capital gains, something like that, or if your 50% of your gross assets are being used to generate passive type income. So if you meet one or two of these tests, then it might actually be a PFIC with additional filing and compliance. It's perfectly doable. It's just that we need to be aware, ask the right questions so we understand the portfolio company. I'll tell you this, many of the companies we're working with, many of the funds, their investments are typically in active trades or businesses. So it doesn't come up that often, but every now and then there might be, when you're investing in a portfolio company that have, maybe a more elaborate structure or subsidiaries, or they may have so much cash sitting on their books that they actually get tripped up with this test. It could come up, and it does come up every now and then, that there's an entity that is a PFIC. So I just want to make sure you're aware of that. You can invest abroad. There's just additional US tax compliance involved.
Got it. So Kelly, just real quick. So if I invest through my fund into like a life sciences company that's like researching some pharmaceutical breakthrough, and they have $10 million sitting earning interest of 5%, is that a PFIC or is that not a PFIC because it's an active research or trade or business?
It depends. So you have to look at all the measurements. What are the other assets on their balance sheet? What other income are they generating? And you have to do this test to figure out if they are a passive foreign investment company. There are also certain exceptions like safe harbors when you're first starting up, that you might be exempt. So then you might be okay in the first 2 years, but then further on into the life, it may actually be considered a passive foreign investment company. So most of my clients, their holdings they're fine, but there's always a one-off here and there that we need to look out for. And unfortunately, with U.S. income tax compliance, the penalties are high if you're not following the disclosure and the filings that are necessary. So we just like to ask the questions whenever you're going abroad, just to make sure it's not a CFC or a PFEC.
Got it. Cool. Thank you. Back to you, Rob.
No, thanks, Nick, for surfacing those. We get these questions a lot. Thank you, Kayla, for breaking it down for us. That's awesome. I want to get into the fun question of how to reduce the tax burden. So I've seen, Ankur, I've seen some of the content you put out from Carrie. I know you talk a lot about this. Maybe you can jump in with some steps that VC funds can, or syndicate managers can take to lessen their tax burden.
Yep. I mean, I think like there's a long list of strategies, but when you look at, where the meat is on the bones or whatever, QSBS by size of benefit, there's nothing else quite like it, right? For me, from a founder's perspective, it's funny. I built a startup for all these years without realizing about QSBS until about 2 months before we exit. So it was one of the nicest surprises, we sort of ever had. But for people who aren't familiar, the way QSBS works is, and Kayla can correct me if I miss something important, which I probably will, is generally if you hold shares from a qualifying C corporation, and there's all these rules that a corporation has to, pass to be a qualifying C corporation. But the good news is most tech startups, typically qualify. And if you hold those shares for, 5 years, buy them from the company, you can pay no taxes on the first $10 million of gains or 10 times your basis in the stock. And because the QSBS exemption is per shareholder, if you look at the cap table of any company, founders are eligible, employees are eligible, investors are eligible. And because you're investing in a fund that is sort of a partnership, on a per partner basis, everyone is also eligible for potentially, no taxes when the company sells. Kayla, what have I missed?
No, that was actually really great overview. I can just tell you in practical application some nuances that I see come up that might be relevant.
Yep.
One is certain things, they have to make sure at the portfolio company level they're not tripping up. For example, redemptions. If there are people coming in and out and redeeming their shares, that can actually trip it up and disqualify the eligibility. So be careful with that. There are ways to get around it. You can just sell it to somebody else and not redeem it. That can help you get around it. There's certain minimum thresholds that if it's a very small percentage, it can be okay, but that's something that does come up. I would also add, this is an individual determination. So one is the qualified small business, the portfolio company itself needs to meet a list of tests. There's like a good 12 tests that it has to meet. But each investor, there are 2 tests that it has to meet. One is that investor had to have held that stock for more than 5 years, and it could be on a look-through basis through the fund. What that does is many times we see like subsequent closes, right? The fund starts up, maybe 10 investors come in, they start making acquisitions. If you have now a subsequent close and another 10 investors come in, they were not there at the original issuance when the fund purchased that asset, that portfolio company, so they may not be eligible. It doesn't taint the fact that the original 10 partners that came in are eligible. They're good. It's just that each individual then needs to measure the date of the acquisition from when they came into the fund to ensure eligibility. So that's a key point. Or if there's like a secondaries fund, if they're buying it on the secondary market, that doesn't either work. And the other thing is, so it's original issuance and the 5-year holding test that each individual investor needs to meet. And we also get a lot of questions with carried interest. If the fund is entitled to carried interest, right, and they're going to get an extra 20% of the capital gains from the fund flowing to the GP, is that those capital gains, eligible for this exclusion? So I know that's a really big question. We won't go into too in depth, but I will tell you this. There are many commentators that think it works and many people that think that it doesn't work. And the reason there's all these questions surrounding it is because the actual tax law in section 1202 for qualified small business stock, it just refers to a partnership interest. It doesn't specify what is a partnership interest. Is that just a capital interest if I contribute a capital, or does that uncover a profits interest, like a carried interest? And then there's this provision, section 1045, which is what Ankur mentioned, which is the 1202 qualified small business stock. But what if you sold it short of the 5 years, you only held it for 4 years and you sold the stock? There's a rollover provision that you could take the proceeds of that sale within 60 days and reinvest it into another qualified small business. That's like a sister provision. That provision specifies only a capital interest is eligible for this rollover. So it makes them question if there's no regulations on the qualified small business rules, but really is the intent, could you use it for carry? So there's people on both sides that say, well, you don't have to apply 1045 to 1202. It's two separate provisions. So maybe there's an opening there. So again, this is something we just say the GP, it's a position you're taking on your personal tax return. So the GP should have this discussion with their tax advisor to make sure they're both comfortable and can take that position. But that's a big topic that comes up in venture and carry.
On section 1045, because I find that to be one of the most fascinating sort of parts of this. So my understanding there is if you hold shares for at least 6 months, but less than sort of the 5-year period, you have the opportunity to take the entire pre-tax capital gain, pre-tax amount, and invest in another qualifying small company, but it's a very short timeline, 60 days, right? Can you theoretically use that to fund a C Corp that you own, like to start your own startup, or does it have to be like a third party sort of company?
You can, I believe you can. There are no rules that I'm aware of related party.
Cool.
So I believe.
Cool. Yeah, that's what I believed as well. So it's kind of powerful if you can basically have any company exit that doesn't hit the 5-year mark. You can take that entire pre-tax amount, defer taxes, and get the clock keeps ticking.
I'll tell you what the issue is that I do see come up in this fact pattern. I just had this with another client. They did start their own, formed a new corporation, rolled over the proceeds, and they tried to get business off the ground, but they ended up not being, they were doing some research development. They ended up not meeting all the tests because the company was almost just like a holding company for a while.
Right, that's an active trader business.
Could trip up other rules. But yes, if you have another idea and you can roll it over, it's a great way to defer tax and potentially get the exclusion on the back end. What I do see in the venture world is many of the venture funds I'm working with have a provision that they could recycle capital. So if they're early in their investment years, let's say, year 1 and 2, and for some reason there's an investment that had a great opportunity, they're exiting and they have these proceeds, they can reinvest it into another qualified small business and just roll over because they can recycle. So the actual partnership can make that election and roll it over. And we do see funds that comes up every now and then. It's not easy to make happen because you have 60 days from the day to sell, but they were already looking into new investments that were qualifying. So it worked for them.
And does it have to be, from a fund perspective, does it have to be an equity investment, or could it be a SAFE, or is that just a whole other can of worms for the rollover?
Great question. We just did a webinar on this topic. So SAFE agreements, I'll go into SAFE agreements for a moment. It's a simplified agreement for future equity, which I think from a legal perspective, I mean, Nik, you can speak to this maybe. It's supposed to be very simple and it's like a template. However, for tax purposes, it's not as simple. What you need to first do is understand the terms of the agreement and determine what the tax treatment is. Is the SAFE agreement, is it considered debt? Is it considered a prepaid forward contract? Or is it really considered equity on day one? So it depends on what the terms are. What we're seeing lately is that the pre-money valuation agreements typically are not considered equity. For tax purposes, you would treat it as a prepaid forward contract, which basically means your holding period doesn't begin yet. You just made an advance payment, but it's when you actually receive the equity that your holding period begins. However, the post-money valuation notes that we're seeing lately, they're very equity-like. They give the holder dividend rights. The terms are much more equity-like. By the way, we hardly ever see any interest. You don't even see those in the agreement. So it's not it's not debt. But the equity rights are, if it's very equity-like, and we will then determine, this is actually treated as equity on day one. And that's a really important factor, because if it is, then your holding period begins immediately. So you treat it as if you own the stock, as if you're on the cap table, and your holding period begins, and you could potentially then be eligible for a qualified small business stock, starting with the holding period beginning on that date. So that's it's a pretty hot topic, been coming up quite a bit. So the answer is, it depends. You have to just read the note and the terms to determine the treatment for tax purposes.
Makes sense. I guess a question for either of you all, in terms of your clients, what percentage of, would you say, from look at a venture funds portfolio, in today's day and age, what percentage of companies do you think are trying to sort of qualify for the QSBS exemption? Is it like 90+%? Is it a smaller number? What do you sort of see? I can kind of tell you what we were seeing as well, but yeah, curious what you've been seeing.
Very high percentage. Most startups, many of them will open as a corporation. Many of them will start out as an LLC, as just a regular operating partnership. Typically what we see is once they're starting to raise capital and they're going to venture funds, they often convert to a C corporation. And part of that is getting, eligibility for QSBS and other reasons, which Nik, I think on the structuring side, we didn't really get into, but an important factor is what we call ECI. If you're investing in a flow-through partnership with operating income, the income flows up to the fund. And if you have foreign investors or tax-exempt investors, that income is considered ECI or UBTI, which is effectively connected income with the U.S. trade or business, or unrelated business taxable income for a tax-exempt. So what ends up happening, maybe we'll take a moment, Nik, maybe, and just go into the structuring for a moment, because I think we didn't get into that on the structuring side, and it's critical to the structuring of the fund.
Yeah, happy to. I mean, I think this comes into play, right, where you have non-U.S. investors investing into, right, through a pass-through entity like a fund, which then makes an investment into a business in the U.S. that might produce this type of income. I know that depending on the assets, right, this can also be more problematic. For example, if it's a real estate-oriented business, I think there's like a whole other can of worms that can arise.
Right. Yeah. So we do see this coming up quite a bit. I would say that most of at least the clients that I'm working with, they're investing in convertible debt, safes, or preferred equity, or just common stock. They're fine. But if you're going to make an investment in an operating partnership and you have investors that are non-U.S. investors or tax exempt, then the flow-through income from your operating portfolio company up to the fund has adverse tax consequences to the foreign investors and the tax exempt investors. So for the tax exempt investors, they're usually tax exempt. They're not paying taxes on interest and dividends or capital gains. But if they get this income of ordinary operating income, they now have to pay tax. The same thing with foreign investors, the income flowing up, first of all, the fund is now responsible to do U.S. withholding taxes, ECI withholding, for those investors. So it becomes the fund's responsibility to remit it to the government. It's a holdback from those foreign investors. And the foreign investor needs to now comply and file a U.S. income tax return in the U.S. And they might not want to do that. So there are alternative ways to structure around this to get out of this. So what we'll often see in the structuring process is that you might see some, hear the term blockers, or it's really a corporation, because a corporation, the income doesn't flow through the corp up to the fund. The income, it's blocked and it sits at the corporate level. The corporation itself pays the income tax and doesn't flow up to the fund. So if you're inserting a corporation, a corporate blocker, it will mitigate these tax issues to the foreign investor, the tax exempt investor. We do sometimes see more savvy foreign investors that will set up their own U.S. corporations to actually come into the fund and invest for these purposes. Or sometimes there's a feeder fund, there's a master feeder structure, and there's a feeder fund that has its above the master fund, there'll be a corporate blocker so that they won't, again, have these issues. But there are a number of issues with doing a corporate blocker above the fund. It's not as efficient. What we'll typically see is the fund, if they're making an investment that has this adverse impact with ECI or UBTI, then they'll just set up their own corporate blocker below the fund for this one investment to block it. Or that's why they ask the startups to convert to a C Corp to mitigate these issues. So again, fundamental in structuring, as Nik started out at the beginning of this whole thing, tax structuring, it's about who are your investors, US, non-US, and what types of structured investments are you making? that kind of drives what your entity structure will look like.
Yeah, thanks for that, Kayla. One little point on QSBS that I hope helps clarify expectations. I think most funds expect that the underlying portcos will qualify for QSBS. And as a company, I'm not aware of any registration you have to make to qualify for QSBS. It's sort of like an automatic starting period for, when you have that actively operating business and you are a C Corp, I think that the clock just starts.
Yes, that's a really good point. The one is there's no active election you make on acquisition. It's something that the investor ultimately needs to track. And when I'm saying investor, but it could be investor, it could be a founder, it can be an employee who has a stock option in the company. All these people potentially could qualify, whoever owns stock essentially in the corporation. Each issuance of stock, they need to monitor and ensure that they're meeting all the tests to qualify. But there's no formal election, as opposed to Section 1045, that rollover provision that we made. If you want to roll over the proceeds into another qualified small business stock, you actually have to make a timely election on the tax return. So that's great. So what happens is I always encourage my clients, let's be proactive, right? When you're first making the acquisition, let's find out then at that time, if we're starting off, it's a good QSBS investment, which many times you'll have reps in the agreement saying that it's eligible, and then you just need to monitor through the holding period. But that's like the proactive approach. It's the best. But if you didn't look at it and now all of a sudden you're in a year that you sold the stock and you have a realization, you could still go back. There's nothing that you just go back sort of and document it, showing that they meet all the tests. And it's yours. The burden of proof is on the taxpayer. This is, so keep that in mind, because the IRS is looking at transparency with the K-1 disclosure. They're going after it. They want to see everything going on in the fund or in any partnership. So just keep that in mind, that the taxpayer needs to prove eligibility for this exclusion.
Thanks. This is great. I want to spend a little bit of time from the investor perspective. So the individual investor who's looking at the VC asset class, or managers, right, that are selling the asset class to prospective individual investors. Ankur, will you speak to some of the opportunities, from a tax advantage perspective as an investor going into VC?
So would this mean like investing from tax advantage accounts or what?
Yeah. Maybe
absolutely.
IRA, talk IRA.
Yep. Yeah, absolutely. Okay. So one of the things that I actually had a Twitter thread blow up a while back when there was a great ProPublica article that talked about how Peter Thiel was able to grow his Roth IRA to approximately $5 billion. And he's, I think, 57 now. So in 2.5 years, he gets access to $5 billion tax, entirely free of taxes, which is not how a Roth IRA is meant to be used. But it got a lot of other people wondering, can they use their Roth IRA in order to just basically use it as an investment account and pay no taxes on any of the gains? So a quick overview for people who don't know how a Roth IRA works. Basically, with a Roth IRA, it's a retirement account where you are putting in post-tax money, but in return, you're never paying another dollar of taxes as long as you wait until retirement to take the money out. So what we're seeing now is a lot of people setting up, self-directed IRAs. We actually started supporting this on our platform, where they can invest in startups. And because the investment is coming from their Roth IRA, it's completely tax-free. So at my last company, Teachable, we had an investor who invested $10,000 from his Roth IRA in our seed round. When we sold, his Roth IRA got $200,000, right? And now not only is that entire gain tax-free, he now has he was, I think, 40 years old. So he has another 20 years to keep compounding and growing that account fully sort of free of taxes. So it's a very, very valuable strategy. The only caveat or whatever I would add is you already get QSBS with startups. So some people like to not do startups with a Roth IRA because they're like, I already have one tax benefit. Maybe I'll use this for an investment where I don't have a tax benefit. But we have a lot of investors doing small investments from their startups.
Yeah, that's super interesting. Thanks. I want to now pivot a little bit to like the current landscape. So for managers, always trying to stay abreast of changes, tax legislation being something that's constantly changing. So Kayla, maybe you can speak to upcoming changes that specifically that might impact VCs.
Oh, absolutely. So right now, the first thing I'll say that The House actually passed a bill. It's currently sitting on the desk of the Senate to go through and vote on. So we'll see if what comes out of it. But there are 2-3 items that were proposed that might be of interest to venture capitalists. Nothing so direct to the fund, but indirectly, there were changes with R&D, research and development. Back in 2022, effective really for 1/1/2022, companies can no longer 100% expense the R&D expenses. Instead, they have to capitalize and amortize those expenses over 5 years, which was not a great outcome, because that means you're going to quicker have taxable income, even though you're actually paying cash for these expenses. So it was not a great outcome, but the IRS was, saying that you have to now amortize over 5 years those deductions. So what this bill is, which is on the desk of the Senate right now, is saying is that they would retroactively go back to 1/1/2022 through 2025 to the end of 2025, and basically essentially allow them to go back and fully deduct their expenses, so that you don't have to amortize it. If there are R&D expenses that are offshore outside the US, it's still a 15-year amortization period. But for domestic research and development, you can actually, we're going to see if the law gets passed, but hopefully they can go back and actually expense their research and experimental deduction, take the deduction for it instead of capitalizing. So this is really important because it will directly impact your portfolio companies. And it's a cash flow issue, right? Otherwise, you're paying out money to taxes sooner. It's a timing difference. So that's something that will really impact VC funds, their portfolio companies. Another item is bonus depreciation. Again, this was starting back with 2022. You have to actually, you can't 100% expense your equipment, furniture, build outs. You have to basically depreciate it over a period of time. So they're now, if this bill goes through, you can actually 100% expense these assets, again, which is a big, tax savings. It's a timing difference, right? We'd rather not pay less tax now than wait it out for a number of years. So that's another item that's on the table. There's also discussion of the state and local tax, if they can increase that as part of your itemized deductions. There's always discussion on that. In regard to directly, law that impacts the funds, like carried interest and qualified small business stock, there's currently no suggested law that would actually change the current law. So right now we're safe. And just to, remind you, carried interest back with TCJA in 2020, it was back with 2018. For a fund manager to get carried interest, for the holding period, you don't look at, okay, did I hold this asset for more than a year? The threshold for carry, you have to look through at the underlying asset and say, did you hold this underlying asset for more than 3 years? So that was already, again, this is already a couple years in play, but essentially you only can get the long-term capital gain treatment and carried interest if you held the underlying asset for more than 3 years. So just, keep that in mind. I do think in the venture space, many of the assets are held more than 3 years. Many of them meet the qualified small business stock, which means they held it more than 5 years. So it might not be, come up as much, but every now and then, if there's a one-off or you did an add-on to an investment and a new holding period began, you might get tripped up into this rule with the 3-year holding period. Yeah.
Nik, anything you would add that you're seeing as far as current changes that we should be looking out for?
On the tax front, no, I think that covers it. Thanks, Rob.
Okay, then let's keep going. I think carried interest, K1 forms. I'm curious, what are some other maybe overlooked?
Yes, I guess one topic, if we're sort of looking for topics, because this comes up a lot, is very often fund managers to make their GP commit will actually pledge a percentage of their management fees. And I believe that can be advantageous for taxes, but maybe would love to sort of hear more about how that works and how that could be beneficial and what the thresholds are.
Absolutely. So what Ankur is referring to is what we call the management fee waiver. They actually have something similar called a carried interest waiver, but just focusing on the management fee waiver, essentially what it does is it's the general partner, the manager, essentially is waiving some of their management fee, right? That the LPs don't have to pay this. They're waiving some of their management fee. And in exchange, what's going to happen is they're going to get extra profits allocation when there's a realization. That's the mechanism essentially of what's happening. So the managers, they say we'll waive the fee, and they come up with a percentage of their capital, their commitment that they're supposed to be putting into the fund. So they do it through this mechanism. It's a little bit technical, but the objective is it's a tax play. The objective is to save on income taxes. If the manager is receiving management fees, that's ordinary income, taxed at ordinary tax rates. So it's a 37%. If you're in the highest tax bracket, 37% income tax, plus there's self-employment taxes that you have to pay on it. So what it ends up doing is essentially recharacterizing or circumventing, so to speak, the management fees into capital gains. So if you're going to waive $1 million in management fee, when you're going through the waterfall, you would actually instead get $1 million of capital gains coming through the fund. And the capital gains, twofold. One is that they can actually be eligible for the long-term capital gain treatment, which is 20%. So there's a really big tax savings right there in a reduced threshold, plus a deferral, because you're not actually maybe receiving that for a few years. However, I want to put a really big caveat on this, because you have to do it very specifically, where it has to be that it's not guaranteed, meaning it's only if the fund is profitable. If the fund if you waived $1 million in management fees and the fund did not perform, you're out of luck. You're not getting that payment. You're not getting that $1 million. You're losing it. So the IRS, if it's guaranteed and you're definitely going to be getting it, or the way it's set up is guaranteed, the IRS will never allow that, and they'll essentially end up taxing you on it as if it's ordinary income. So you have to be very careful that there is like substantial economic risk that you might not earn this if the company didn't perform. So there has to be risk when you're waiving this. But if there is risk, and it depends, and then it's a great play. But a key focus I always tell the emerging managers is that if you are waiving, just make sure that you have enough cash to fund your management company, because you're not going to be getting this cash payment and this income. And obviously you need to run your business. So you need to have enough cash to cover. So keep that in mind. So we do sometimes see the strategy use it with either a little bit more established managers, or or depending on maybe the AUM of the fund, it's a bigger fund and it's higher, and your management fees, you can afford to waive it. Very, very facts and circumstance specific, but it's definitely a really great tax saving strategy that we see managers using. So that's a great thought, Ankur, for bringing that up. There are, if I could continue on, there are one or two other topics I would love to just bring up for our audience that I think would be really helpful. Before I mention the R&D, right, the research and expenditure, the expenses, along with that, there's also something called the R&D tax credit, research and development tax credit, where essentially if you're have expenses that are for research and development, there's actually a tax credit that you can get. You have to go through all your expenditures to see what actually qualifies. But if you can get a tax credit to offset your income tax liability. So this is really helpful for the portfolio companies. Again, it's about cash and saving that cash flow and not having to pay taxes. So if you have a corporation that's doing a lot of R&D, they probably would be eligible for the R&D tax credit. And if they had $1 million tax liability and then they calculated a credit of $300,000, they would only pay $700,000 in tax at the corporate level. So keep that in mind. It's making it really important for the fund managers to be aware of that, because a lot of these companies are startups and maybe they don't have, they have small accountants maybe that they're using initially. You just want to make sure, small firms, without maybe the expertise or depth in this area, but make sure that they're getting this credit, because it's going to save you in taxes. And I want to point out, if the portfolio company is a small business under the definition for R&D, and maybe they're in a tax loss position, so they're not even paying income taxes right now, there is an opportunity to use it as an R&D payroll credit. So when they're filing their payroll, they can get a credit against their payroll taxes. So even if you're not, don't have taxable income, very likely you're paying some wages. This can help you the company save payroll taxes if they're very small, like pre-revenue company, or just very small business under 5 million in receipts. If they meet certain tests, this is a really great opportunity that, I would say that it's great. It's good for the fund managers to check in with their portfolio companies to make sure that they're utilizing this mechanism and getting the benefit of the credit. So that's
100%. Yeah, Kayla, I saw that a lot. The R&D tax credit for employment taxes for most, like the vast majority of startups, like in the software space, can benefit from that.
It's prime.
Yeah,
because there are heavy expenses on the wage component developing. So this is a really big tax savings item. And I don't think it gets enough, PR. I think there's a number of companies that are not aware, but I look at it as like we want to educate the fund managers because, it's companies in their portfolio and it's direct cash savings. So it's important. Yeah.
A few others. Ankur, we're having a hard time hearing you.
Yeah, your audio is coming in a little wonky. While Ankur fixes his audio, one other thing that is maybe out there, but there are some jurisdictions where you actually get cash back from governments for R&D activities. Like I'm close to some businesses that have R&D activities in Australia where the government gives them back 43.5% in just cash every year for those R&D activities. So there's a whole world of fun around tax stuff.
Yeah, I guess mine's better, hopefully.
It's still doing it.
It's robotic.
Yeah. And, there's actually another item I think that's also important for fund managers to be aware of. Back with, TCJA, the Tax Cuts and Jobs Act, back in effective 2018, the itemized deduction for state and local income taxes was reduced. So you only can deduct up to $10,000 of taxes, which is pretty low. So what ends up happening is that the states, they were losing, especially high tax jurisdiction states, like, for example, New Jersey, New York, California, those states, they essentially were losing constituents because the taxes were just so high and they weren't even getting a federal deduction for the taxes they pay. So many of the states came out with something called a PTET election, which is essentially a pass-through entity tax election and deduction that you can get. It basically circumvents getting around the state and local deduction. So what it ends up doing, this is something to be utilized mostly for your management company. You could potentially do it for the GP entity. It depends on the state. Again, state specific, and every state has its own rules. But essentially what it does is you end up paying like your personal income taxes at the partnership level. So at your management company, if you're a resident of New York State, then you obviously personally, as a resident of New York State, have to pay New York State income taxes, or if there's sourced income to New York State. But again, we know a partnership, like Nik mentioned in the beginning, partnerships don't pay taxes. It just flows through to the individual. So what this election allows you to do is make an election, for example, with New York State, calculate an entity level tax for New York State, and then take a federal deduction for it, because according to the federal rules, you're allowed to deduct state income taxes on your federal return at the business level. So what ends up happening is, let's say a fund manager is earning, $100,000 of income in year one, or let's use $1 million, because
is this the PT entity tax or
PT election? Yep. So
Right.
let's say the entity is generating $1 million of income. This partner is getting $1 million of income. And they have to pay, to keep things simple, 10% tax to New York State, right? So they're paying $100,000 of New York State income tax. When they get their federal K-1 from the management company, it's not going to say $1 million of income. It's only going to show $900,000 of income, because you deducted the $100,000 as a federal deduction for the state. So you essentially are getting the benefit of your state income tax deduction with this workaround. but the entity needs to be a partnership or S corporation. It can't be a disregarded entity. So you have to be in the right structure for it. But essentially, and then on your federal income tax, if you have a $100,000 extra deduction at a 37% tax rate, you're saving $37,000 right there. So this is a mechanism to help you get the state and local deduction. But I do want to point out every state, more and more states are latching on to this pass-through entity tax. But you just be careful. Every state has its own rules. For example, New York State, you have to make this election at the beginning of the year. You can't decide at the end of the year, I want to do this. You have to make it at the beginning of the year, pay an estimated payments. Most other states don't have that. You have to elect at the beginning of the year. And I'll point out for anyone in our audience that's New York State, that election has to be done in about 2 weeks by March 15th. So just keep that in mind. California, you don't have to make the election at the beginning of the year, so you can figure it out later. But you do have to pay an estimated taxes anyway. But it's a really good strategy. We're seeing more and more clients sign up for it because it's a big tax savings.
It's also, like, to me at least, an example of how the tax code sometimes favors business owners, because if you have that income coming in through W-2, you're out of luck. But on the note of it being a partnership, I was actually talking to an investor who was making a lot of money in management fees, didn't realize this. So he actually ended up putting a family member as like a 1% on their LLC or something, so that they're now a partnership versus a disregarded entity.
Yeah, that's a really good point. I will add in that it can't just be a tax saving strategy. And maybe Nick, you've seen this or know this, but there has to also be some sort of business reason to say it. But yes, we do see that. That's definitely a way to accomplish it.
Cool. The question I was trying to ask when I was having audio issues is, I love the thing on the R&D tax credit. Are there other tax credits, probably smaller, that our portfolio companies should be looking out for? I know there's some small stuff if you start a retirement plan, but nothing sort of meaningful. Are there any other sort of just things that startup founders should be looking for in terms of tax credits?
Yeah, that's a really good question. To be honest, I don't know all of them, but I do know, because sometimes I do like a fund to fund and I see these credits coming up. There's certain wage and opportunity zones or hiring employees in certain jurisdictions that you can get credits for. There's definitely a number of other smaller credits. I think more and more we're going to see energy efficient type credits, depending if they're operating in that space. There are definitely some things that they could take advantage of. With my venture clients, it's mostly seeing the R&D credit, but there definitely is more. My specialty is on the fund side, so I actually don't know enough on the operating, but there's definitely some other credits. Yeah.
You might know, this is not really a credit, Ankur, but I know that there are some cities that charge a tax on gross receipts, even though you may be at a loss income-wise.
Yeah.
Yeah. Kayla, I don't know if you know of any others of those, but that you can, of course, impute the impact of that if you're not income positive, but you have revenue, right? That's many startups face that cycle.
Yeah, there definitely is. I know Texas is a gross receipt state, so there's always something or a minimum that you're paying. There are definitely a number of states that have some provision like that. I think there's also some angel investing programs in certain states. Again, I'm not familiar with them, just throwing it out there. But I do think that there's other credits or some sort of loan or investment that you can get from governments as well that actually might be helpful to our audience, the emerging managers, to be aware of. Yeah.
Okay, well, I think we're coming up on time here, so I'm going to now just try to connect here with ways that the audience can connect. We have the tax expertise of EisnerAmper, right? Looking at how you can follow up with actually getting formal counsel on some of the topics that we've addressed, as well as following up to learn more about Carrie and what the software offers and how you can use that as an individual to get smarter about leveraging tax opportunities for your own personal wealth. So Kayla and Ankur, would you just speak to how we can follow up with your firms for managers who are interested in working with you both?
Kayla, over to you first.
Absolutely. You could connect with me if you want on LinkedIn or just send me an email directly. Rob, will there be something posted, or should we put in the chat or something with our email address?
I'm gonna handle that. So Sydecar will provide a follow-up to everyone who participated, and we'll give them the ability to connect, and I'll include there some links and ways to reach out to both of you.
Yeah, and you can check out our firm's website at EisnerAmper.com. A lot of this that we discussed today, you'll see articles and webinars and blogs on these topics to learn more as well. We're happy to help the venture community.
Great, that works. Thanks so much for joining.
Yep.
This was invaluable, free advice on so many topics that we hear all the time. So we really appreciate you guys spending the time to join and to talk through this stuff.
Yep. And if I can quickly on Carry, let people know, if you want to find us, you can see us at carrymoney.com. I mean, we've built a self-serve platform for business owners to be better with taxes. And we primarily do that by making it easy to set up tax advantage accounts. So if you're self-employed, we help you set up a solo 401k or an IRA or a self-directed IRA. We're launching HSAs soon. Our overall goal is to sort of demystify the tax code and make some of these opportunities easier to access. So check us out at carrymoney.com.
Awesome.
All
Thanks,
right.
everyone. Well, thanks, everyone. Yeah.
Thank you.
See ya.
Bye.